This is the total consumer debt of the United States of America. This is what me, you, and millions of others owe to banks, credit card companies, and other lenders. And while this number feels overwhelming, here's a different way to look at it. You know how it's always tempting to compare yourself to others to measure how successful you are? Well, today we are gonna do the same, but with debt. We are gonna see how much less screwed you are than everyone else. Now, is this the healthiest way to measure your financial health? Probably not, but we'll talk about that later. For now, let's just see if you're sinking slower than the rest of us, starting with America's special favorite, the credit card debt. So the average credit card debt per person in the United States is $6,730. That's right, $6,730 just from swiping for dinners, gas, groceries, and whatever ends up in the Amazon cart at 2 a.m. Now this doesn't sound so bad, but remember, that's just the balance. And the average interest rate on these cards is high, about 21.37%. That's a big deal for the 48% of cardholders that carry a balance from month to month at least once in a year. So if you spent $6,730 on a vacation to Hawaii and took 1 year to pay it off, you'd end up paying $7,534 in total. That's around $804 in interest alone. And if you only paid the minimum, which is usually about 5% of the balance, it could take you more than 2 years and cost you over $1,600 in interest alone. That's crazy. But do you want to hear something even crazier? Well, more than 47% of cardholders have no clue what their credit card APR is. And yet, many of these same people use credit cards to chase rewards like airline miles, cashbacks, or hotel points, thinking of it as a smart move. But what they don't realize is that they're often paying more in interest than those perks are worth. It's like someone took you on an all-paid trip using your own money. Now let's talk a little about student loan, which stands at an average of $35,208. It's often labeled as good debt, and it certainly is, but only if you major in fields like engineering, computer science, economics, and nursing, which can pay off big with lifetime gains north of $500,000. But on the flip side, 68% of programs in visual arts and music actually leave graduates financially worse off. According to a study, nearly 1/3 of students are in programs that offer no financial return on investment. That means 31% of students are paying tens of thousands of dollars for degrees that don't pay off. And it gets worse with grad school. About 43% of master's degrees don't deliver a positive return either. And what's even more shocking is that 2.8 million federal student loan borrowers are 62 or older, carrying a combined debt of $121.5 billion. Yes, senior citizens are still paying off student loans. In fact, 114,000 senior citizens have already had their Social Security garnished for missed student loan payments. Now, before you toss your college degree out of the window and declare higher education a scam, take a look at this chart. It shows that if you didn't even finish high school, not only will you earn significantly less over your lifetime, but you'll also face higher unemployment. So education still matters. Just maybe don't go $80,000 into debt for interpretive dance. Be smart about the field you choose. Next up, auto loans, the money we pour into shiny, fast, debt-generating toys. So the average car loan in the US is $24,297. Now sure, transportation is important. You gotta get to work, pick up the kids, and run errands. But what's baffling is that 1 out of every 5 new car buyers has monthly payments over $1,000. Yup, $1,000 a month for something that loses value faster than last year's iPhone. Now let's put that into perspective. If a household makes the US median income of $80,610, that $1,000 car payment is eating up 15% of their pre-tax income. And we are not even counting insurance, gas, or maintenance yet. That's a serious chunk of change for a rapidly depreciating asset. So it's definitely not a surprise that Americans owe $1.65 trillion in auto loan debt, making it the second largest pile of consumer debt after mortgages. And speaking of mortgages, they take the crown as the #1 consumer debt in the US, standing at a staggering $12.11 trillion. The average mortgage, however, is $252,505. That might sound like a massive number, and it is. But it makes sense considering a home is usually the biggest purchase most people make in their lifetime. And when it comes to chasing the dream home, many don't hesitate to sign on the dotted line for a 6-figure loan. On top of it, mortgages are often seen as good debt because homes tend to appreciate in value. But here's the twist. The long-term inflation-adjusted return on US housing is only about 0.4% per year. That's less than what some saving accounts offer without locking you into a 30-year contract. And when you factor in maintenance, property taxes, insurance, and transaction costs, owning a home might not be the wealth building strategy it's hyped up to be. And let's not forget, the house doesn't really belong to you until the mortgage is fully paid off. In fact, according to a real estate data firm, Atom, 2.7% of residential mortgages were seriously underwater, meaning people owe way more than their house is even worth. And that's exactly why the renting versus buying debate never seems to end. Because for many, the housing market feels like one giant overinflated balloon just waiting for a sharp pin. What do you think? Is owning a home still the American dream or just an expensive illusion? Drop your thoughts in the comments. I'd genuinely love to hear them. Now, can you guess how much the average American owes when you combine all types of debts except mortgages? Here are your options. If you guessed B, you're right. The average American carries around $105,000 in debt, excluding the mortgages. That's 6 figures of liability weighing down the average household. Now tell me, does seeing this number make you feel like a financial genius for being below it? Or are you currently spiraling into existential crisis for being above it? Either way, here's the truth. Comparing your debt to others is useless when it comes to measuring your financial health. It's like bragging about sinking slower on a sinking ship. What actually matters is your net worth. It's everything you own minus everything you owe, aka your debts. So your first goal should be to get that number in the positive. Then grow it, nurture it, and add some zeros to the end of it. Because the ultimate financial win isn't carrying less debt than your neighbor, it's having none at all.